Hello all, Bob Pisani here. We are here in Las Vegas at the Exchange ETF Conference. This is the largest gathering of ETF professionals, roughly 2,000 asset managers like BlackRock and Vanguard with investment advisors that buy the ETFs, all here to discuss the latest investing trends. Let's talk to four of those industry leaders. These are all-stars, folks. Ben Johnson is head of client solutions at Morningstar. Ben Slavin is global head of ETFs at BNY Mellon. Jay Jacobs is U.S. head of thematic and active ETFs at BlackRock. And Travis Spence is J.P. Morgan's global head of ETFs. These are the best in the business, folks. Ben, let me talk with you. I often say you're the philosopher of ETFs. Probably 1,000 investment advisors here. What are they looking to get out of this conference? I'm sure they want some help managing all the trading chaos that's going on, but what else are investors looking to get out of this conference?
Yeah, Bob, I think the advisors that are here today with us are looking for what they're always looking for, which is answers. Answers to their questions and, by extension, their clients' questions about what's going on in the markets, how do they respond. I think, importantly, who are the partners here that are represented in these halls that they can trust to give them those answers, that context, those tools, those products that help them to build sensible, well-constructed, diversified portfolios on behalf of their clients so that they can weather any sort of environment, be it the chaos that we've had recently or calmer times like we had as recently as last year.
Yeah, Ben Slavin, BNY Mellon manages a lot of the back office functions. You manage and run the plumbing here, but what I find is these RIAs really want some help also managing their business, what we call practice management. They want to know how to grow their assets under management. They want to know how to handle things like back office functions. Are they getting help here to try to do that?
Well, I would certainly agree with the philosopher here for sure. But I would also say that, it is an increasing trend where it's more and more about helping those advisors, again, with their practice, with those back office functions, which making it possible to make their jobs easier instead of just talking about products, which is increasingly becoming a noisy space here. There are an incredible number of products that have come to market, and from a BNY perspective, we're running at about the same pace in terms of both new issuers and new products. That's creating a ton of noise in the market, making it more complicated than ever for the advisors here to sort through that range of products.
Jay, what's BlackRock doing to help people here? You have many products to choose from, but they also want help managing that business, that practice management part. What does BlackRock have to offer?
Well, I think there's many aspects to this. One is product innovation is still key to helping advisors manage their business. One of the trends we see right now is in digital assets, how much advisors can help their clients, particularly millennial or Gen Z clients, who have been buying things like Bitcoin on their own, but now increasingly want an advisor to help them manage that in the context of a broader portfolio. So I think that is one solution. Another is looking at model portfolios and how BlackRock delivers really kind of entire solutions for advisors that are looking to focus more on their client. We can provide the kind of backing to that with well-constructed portfolios across ETFs and equities, fixed income, and even alternatives.
Travis, J.P. Morgan has the same thing. You have similar products to help the RIAs out in terms of asset management, but as I mentioned, they also want help. How do you help them grow their assets under management? That's the holy grail here at the RIA.
Yeah, well, look, I think an event like this gives all the advisors a chance to think about what's at the leading edge, what's happening in terms of trends in the industry. They also want to be at the leading edge for their clients, and understanding those trends and what's working, especially in a market which is so choppy and volatile right now. So I think one of the biggest things that we've seen, Bob, is the continued growth on active ETFs. So you think about that. Last year, about 8% of assets took in 26% of flows here in the U.S. It's already up to about 34% this year. Active is becoming a bigger part of portfolios, and a lot of advisors are trying to think about how can they start to introduce active ETFs into their portfolios for clients.
Well, that is a hot topic, Ben. Actively managed ETFs are about 10% of the assets now. We have $11 trillion in the ETF business. About 10% of it is active. And I'm looking here, 30% of the flows this year have gone into active ETFs. Cohen & Steers just started, an old firm, very respected, an active real estate fund there. So what's happening with active this year?
We've seen this trend really start to emerge starting last year, even before that, but it's really picked up some steam. There's a lot of reasons why that's happening in the market. Part of it is, again, just the number of products that are on the shelf at this point. There's more options for advisors. But also when you step back and you think about what's going on in the market, certainly the market conditions have given advisors more of a reason to look at active. But also a lot of these products have started to scale, which has made them available or eligible to be put on platforms, effectively opening them up to being invested by advisors and their clients. And also many of these products had been planted a few years back, and the track records are starting to build with 3+ year track records that are really another hurdle for advisors and clients to give a real serious look to using active inside their portfolios.
Your point is 3 years is what a lot of people use as a benchmark for 1 year's not enough, 3 years is sort of minimal, 5 years is better. Jay, you have a whole suite of active products there. What is BlackRock doing here?
We do, and I think key to what Ben was just saying is the market environment. If you look at the last 10 years, the average annualized return of the S&P 500 was 13.5%. So most people got away with just kind of broad beta to the markets in delivering their financial goals. Going forward, our capital market assumptions and a lot of firms around Wall Street are saying it's more like 6% within U.S. large cap. So increasingly, investors have to look at differentiated strategies, active strategies that can add alpha. We've seen a ton of success in rotation strategies that are playing some of the volatility in the market today, whether it's DYNF, which is actively rotating factor exposures, or Throw, which is actively rotating themes like artificial intelligence and tariffs to be able to play some of this market vol and generate alpha.
Bob, there are a couple of trends that I would point out. We've seen about $100 billion already go into active ETFs this year. That's pretty tremendous. I mean, that's kind of on record pace. You think about last year was a record in the active ETF industry. We're already above that active pace, but there's two things that are happening within the active ETF space that are trending. So one is just a more risk aversion, and I think just given volatility that we've seen so far this year, so things on our platform like JEPI and JEPQ, which give a lower vol access to the equity markets, but are still giving income 7 to 9% on the over a broad index and 9 to 11% in the NASDAQ side. That's been really attractive. And so there's been a de-risking. The other big thing that's happening is fixed income and active fixed income and ETFs. It's made up about 40% of all the fixed income ETF flows this year. And we've already seen, again, about $100 billion that's gone into fixed income ETFs. So that's really starting to pick up. But I think as more options become available, as Ben said, most active ETFs are still under 3 years old. As they gain track record, as they gain scale, we're going to see that 10%, we think, grow to about 20% by the end of this decade.
Ben, I want to move on because fixed income is another hot topic here. Ben Johnson, big inflows, as he mentioned, into bond funds this year. I'm wondering why. I mean, it seems to be there's a market volatility, so there's a sort of flight here, a flight to safety play too. But also, and you and I have talked about this, the population is aging. So it seems to me there's a sort of natural upward bias towards bond ownership. But tell us what's going on. We're seeing significant flows this year into fixed income, particularly ultra short is happening.
Yeah, bond funds have some very strong secular tailwinds at their back, right? You think of just the aging investor demographic and the fact that as you get near or enter retirement, you're naturally going to want to de-risk your portfolio. You're going to take equity risk, take stock risk off the table, reallocate to fixed income, which today in 2025 is fundamentally much more appealing than it was just a few short years ago when the risk-free rate in real terms was negative. You were losing money after accounting for inflation. So now that we've seen the return of the risk-free return, now that we see appealing yields, now that we have these demographic tailwinds at our back, it's not surprising to me that we've seen flows into all form of bond funds, be it actively managed ETFs, index ETFs, and actively managed mutual funds absolutely surge.
It makes perfect sense to me. Our viewers love their money market funds. I mean, 4%, you're right, it was nothing a few years ago. Makes perfect sense to them. And they're actually getting an inflation-adjusted real return for the first time. And that is a very sticky group of people. It is hard to move them out, even with 20 22% in the S&P 500 last year. We had, what, $6 trillion in money market funds? They didn't move. We kept saying, when is this going to move? And it didn't move. So are people making rational decisions at this point?
Well, it didn't move. Those balances remain high, and we saw a record for the ETF industry last year. So it goes to show you that money is coming from somewhere else, and it's actually a bullish sign for additional flow. But going back to fixed income for a second, I would say that, you know, when you think about actively managed ETF history, it was really fixed income actively managed ETFs that were the OGs, so to speak, of the industry. They were the ones that really sort of led the way. Ultimately, equities took over, and now they're sort of making a comeback. Part of that reason also is really the action that we saw in the fixed income markets. A lot of that money came out when the bond market got hit. And as we know, in these market cycles, when money comes out of mutual funds, the ETFs once again benefit. That money is not going back into the mutual fund wrapper. It's ETFs that are picking up that share, and we're starting to see that in fixed income ETFs, especially the active variety.
Yeah. I want to move on to another topic because there's 4 or 5 of them I want to hit here. Private equity, private credit, very high levels of interest, but the assets are illiquid, and this is proving to be very tricky to provide in an ETF wrapper. We saw PRIV recently go public. There is some CLOS offerings out there. It seems to me like it's still not clear if ETFs will be the dominant space for trading private equity and private credit. Give us some thoughts on how this can happen, or maybe it not happen. Maybe BDCs is the better route to go. I don't know. It's very tricky here, it seems to me.
Look, I'll kick it off, and I'm sure we all have views on this. I think the great trend that's there is innovation, right? And that's always been a hallmark of the ETF industry, and I think that's what we're seeing happen. Now, the question that needs to be answered is, can you take a private that doesn't trade that much and is illiquid, and you have a premium for being illiquid, into the ETF wrapper? It needs to be priced on a daily basis, and you need to be able to have extra liquidity, and there needs to be a market for it. So I think there's still some questions that need to be answered around this, but those are some of the topics that need to be unpacked in terms of bringing this to the next level and making it a reality.
I think you can look at the financial space as so many different structures for different users and different asset types, right? Mutual funds still continue to make a ton of sense for retirement accounts, for more liquid assets where portfolio managers want to shield what they're buying every day. Interval funds have been really successful for private credit thus far. I do think a lot of winds are still blowing towards ETFs, and I think we'll see more innovation with private investments. One of the things we're looking at is, can you do more indexing of private investments? So we made an acquisition with Preqin this year, and a lot of it was really around the idea that if you have time series and you have the data aggregating a lot of what's happening in the private space, you can start to index private assets, and then maybe you can build some products off it. We've seen plenty of different...
Preqin does private credit analysis, essentially. I mean, you mentioned Preqin. Don't assume they know what they do, but that was a big acquisition for BlackRock.
Yeah, so they're an alternative data provider. They do, all different types of private investments, whether it's, private equity, private debt, et cetera. But what it opens up is the ability to potentially do more indexing of private assets. And what we've seen in the ETF space is you can index a lot of different things. You don't necessarily need to physically hold them. As long as they're indexed and you could have futures or other derivatives tracking those types of investments, you could potentially build an ETF that tracks
I guess,
them.
Ben Johnson, the question is, can we shoehorn private credit, private equity into the ETF wrapper? We have structures that already exist. Business development corporations, yes. BDCs, they do this. That's what they do. Interval funds, these are sort of like closed-end funds, those of you who don't know, folks, and they've existed in this structure for years and years and years. Can you fit this somewhat illiquid asset and shoehorn it into the ETF wrapper?
Yeah, Bob, I think there are a few different questions here, which is, can we? We've proven that we can. Should we? I'm still not certain. And does it ultimately deliver what investors are expecting? I think at least in many of its current forms, I think back to the old Wendy's commercial where they lift the hamburger bun and they ask, where's the beef? Well, you're not getting a lot of beef right now because you have to water down a lot of what investors really want, what they're after, which is private markets exposure, to get it to work in an ETF
You have to water
wrapper.
down because the SEC won't allow huge amounts of illiquid investments in a private fund, in a fund like this, right?
Yeah. So that's not to say we couldn't reach a point in time And I think back to the example of bank loans circa 2011, where you looked at that asset class, you looked at the infrastructure, you looked at the liquidity, and we balked in that moment at the idea of ever wrapping bank loans in an ETF, but now it seems fairly commonplace, fairly mundane.
BKLN did that, actually.
Perfect example.
There's a bank loan, State Street did that, right?
Vesco did that,
I'm sorry,
so
excuse me.
I think a great example of where this might go, but for the time being, to Jay's point, there are already a number of different vehicle types, I think most notably interval funds, that allow you to get that exposure at the level that you want,
but they're
with
not
the outcomes that you want.
Interval funds are not publicly traded, though.
They're not publicly traded, but they're ticker-based. You can subscribe daily in many cases. You're sacrificing liquidity on the way out because maybe you can only get out once a quarter. But nonetheless, you get fuller exposure to these private assets.
So your point is maybe we shouldn't shoehorn this into an ETF space because you're not really getting what you think. You think you're getting private credit, but in fact, there's a limitation to what you can do in this.
And I think interval funds and other evergreen funds,
better vehicles.
non-traded BDCs are kind of the middle bowl of porridge in this Goldilocks
Any
scenario.
thoughts here?
Yeah, I was going to say, first of all, I love the analogy for the first time with private credit, talking about the beef and Beyond Meat, sort of analogy, which is a great way to think about it. But I would just say, agree with sort of the comments that have been made, but stepping back, across our business, we are looking at an incredible amount of demand from ETF investors who are looking for access, which has been one of the hallmarks of ETFs from day one. And the other side of this is really those managers, especially who are focused on alternatives. Some of the largest investment managers in the world are looking to push more into that wealth space, to tap into that growth. And ultimately, it's about trying to meet investors where they're at. And ETFs obviously are the place where investors are going. But again, there's these other structures that are also trying to satisfy that demand.
Bottom line is it may or may not be the right structure, but we already have structures to address investing in private equity and private credit. I want to move on here. So another hot area, and this is somewhat in the active management space, is option income and buffer products that are out there. Option income products are very interesting that's going on with them. These are tapping into the interest in people who want to provide regular income, essentially. So these ETFs sell call options, and these are typically on the S&P 500, and they cap some upside potential but also provide a monthly income, essentially, from selling the call options. And the buffered products provide exposure to the S&P 500, typically the S&P, up to a limit, and then they provide a buffer against some of the losses. So these products have become very popular with investors who want to stay in the market, but provide some kind of downside protection. So we've seen this, Innovator, Bruce Bond's fund, some of the other ones that are out there. These products make some sense to me. Ben, how have these products been received? They seem to be gathering assets under management. Do they make sense to you too?
Look, clearly, when you look at the flows, there is demand for these products, and they're filling a need in the market. I think we've certainly seen a couple things. At this point in the market, obviously it's resonating with advisors. I think also there's been a tremendous amount of marketing and education that's gone on around these products. I mean, ultimately trying to raise assets, but that has also helped to really get the word out to advisors and also explain how these products can be used inside their portfolios, which again, until recently was not really well known.
Right. So in option incomes, and I want everybody to understand this point, you're selling call options, you're collecting premium, and you're distributing that to the investors. It depends on what the percentage is, 7, 8, 9, 10%. With buffered products, you get exposure to the S&P up to a limit, and then if it drops, you get downside protection. So what I like about this is these people aren't just exiting the market. I'm 70 years old, I'm worried, I want to drop my exposure from 70% stocks to 20% stocks, and I'm not in the market. I'm here, I'm still in the market, but I have a collar around me, essentially.
And I don't think it's just about exiting. I think a lot of this is about entering the market. When you see the trillions of dollars on the sidelines in money market funds, a lot of investors are using buffered products to step out of cash and into the markets. No one wants to be the person that held cash for 5 years, just put their money in the market and watched it sell off 10%. So using a product like a max buffer ETF that limits the entire downside at the beginning of its inception period with a capped upside can be a really good tool for kind of almost a replacement for dollar cost averaging, bringing people out of cash back into being invested in the markets.
This has been one of our biggest strategies, and as you know, with JEPI and JEPQ, we were an early innovator into this space to provide that outcome of being able to stay in the market and collect income along the way. We see it as there's multiple ways to win within a strategy like this. You can remain invested in the equity side and get the return from the equity market. You can capture that extra premium income that adds to, I think, a growing need and a growing desire for income investing across all asset classes. And so we see that as a really effective way to keep people invested. And usually when you come out of the market, that's when you lose the most. We want to keep people invested through the cycle. And so we've seen a lot of demand, especially this year, given the volatility in the market. That's where these products really shine. And that's been an effective
and
outcome.
JEPI, that was the leader in selling call options and collecting premium. What kind of yield are we talking about right now, like on JEPI? What's it throwing off?
So JEPI is taking a broad market access. That's what you get in the underlying portfolio, but you're getting 7%. On that. In the NASDAQ version, in JEPQ, it's about 11% now. So really attractive to keep people invested through the cycle.
JEPQ is the NASDAQ version.
Correct.
All right. So 7%. Now you are, of course, as people understand, you're selling a call option here, so you're giving up some upside protection.
Yeah.
But you're getting income at the same time.
That's right, and you should be willing to give up some of that upside in order to. It's a trade-off, but that's an effective trade-off, I think, in a market that's going to be a little bit more choppy, where you still want to have active management on the underlying portfolio, which again, I think we're going to see more and more appetite for active management just within overall broad traditional portfolios.
Ben, you want to say something?
Yeah, and Bob, I would emphasize that this is kind of an instance of almost like old wine in new bottles. None of these strategies or anything, in many cases, are unfamiliar to
JP Morgan's
advisors.
been doing this for their headier, more advanced clients for 30 years, right? But now it's just in this wrapper that we see in BlackRock. You've been doing this for a long time, right?
Come back to everything that we know and love about ETFs is that they make it easier to tap into these strategies, to implement these strategies. They make it cheaper to implement these strategies to the extent that buffer ETFs at the margin are taking share from structured products, which can be really expensive, super illiquid, and generally just investor
That's the beauty of this wrapper. Guys like JP Morgan have been doing this for clients for decades, and now you actually have advantage of stuff that what you couldn't have done 30 years ago. You would have had to been a high-end client at JP Morgan. They would have done a custom portfolio for you.
Yeah, I think it's another fact that I think people are starting to realize is that in the active management space within the ETFs, a lot of times you're bringing the best of your capabilities, as what we try to do, into the ETF wrapper. So you're right, we've been running strategies for 30, 35 years with great track records, and we're now introducing that to give the access of an ETF to those same portfolio managers, the same research analysts that they would have otherwise had in other vehicles, but now it just becomes easier to access those.
I want to move on. Another hot topic is ETF share classes of mutual funds. Now, you may know Vanguard actually pioneered this structure, and it allows an ETF to be used as a share class within a mutual fund. Now that the Vanguard patent has expired, there's roughly 50 firms that have filed to offer ETF share classes of their mutual funds and are awaiting SEC approval. So give us a little sense. We had a panel yesterday with a bunch of lawyers, which was very interesting. They seem to think this is a real front burner issue with the SEC. Are we going to see this, and sort of explain why this is important? Don't assume everybody understands what's going on.
Yeah, so your first question, Bob, my thesis has been that it's a matter of when and not if. Per that panel yesterday, it's sooner than I think I would have expected. They expect it to happen maybe as soon as by the end of this summer. And why this is important is because it's a structure that ultimately could benefit millions of investors who have assets in mutual fund share classes today that would benefit from being in a combined fund that would have an ETF share class that could be used to manage the tax profile of the fund. So part of the reason mutual funds have been in outflows now for so long is that every year a lot of them have been sending investors effectively a lump of coal in their stocking at year end in the form of a taxable capital gains distribution, which they didn't earn, they earned because other investors left that fund. So the ETF share classes appended to the mutual fund would help improve the tax efficiency of the fund to the benefit of everybody.
Because the ETF structure allows you to essentially wash a lot of that away.
Can send all the low-cost lots out the back door via in-kind redemptions. So 51 firms now have filed as of Friday. It may be happening soon, but I think it's the first step on a longer journey because there's a lot that still has to be done and just kind of the plumbing of the industry to actually make this a reality.
Just explain what, if I have a mutual fund and then I have an ETF share class in that, does it matter if I'm in the ETF share class or in the mutual fund share class if this actually happens? What is there any advantage here? What should I do? And I presume this is this is an unallied good thing, right?
It is a good thing. I think you did a great job articulating how it's good for investors, and it's also good for a lot of the issuers here at this conference, for sure. It's really a game changer. And look, there's a lot of work that needs to be done in the background from a servicing perspective to make all the plumbing work, as you say. But the concept of multi-share classes certainly has been around the industry in the mutual fund context for forever, or for many decades. It's also a concept that is applied to ETFs really in other parts of the world where it's commonplace. It's just not the case here. So all of that know-how and the infrastructure really exists, and we're looking to apply that here. But ultimately, there needs to be a common solution that really helps to standardize this process along the industry to make sure that it effectively functions the same way. And also, most importantly, the distribution platforms, the brokerage platforms where clients access ETFs are able to do so, and those platforms are able to handle any kind of switching easily with a seamless experience for the shareholders. And easy to say, a little bit more challenging to do.
I want to move on, but any quick thoughts? Again, for the viewer here, if I have a ETF share class and I have a mutual fund share class, does it matter anymore whether I own one or the other?
It's more choice and access for investors. I think you've heard it multiple times on this panel. ETFs have been democratizing investing for a long time. We've seen it with active ETFs launching. We've seen it with some of the alternative strategies coming out. I think you could view share class, if that gets passed, as being another sign of kind of more access to more investors of different strategies.
So you can wash capital, these kinds of capital gains essentially through both of these share classes when they're there. That's the key point here.
Yeah, look, I think it's adding optionality for the issuers to be able to deliver the strategies that they have in the most effective way for end clients. And I think that's where this will wash out ultimately. So it's adding flexibility, which I think is a good thing overall. And we're just going to have to see, by strategy and from some of the distributors, what do they need to have in order to deliver the most effective solution to their client.
I want to move on. One or two final topics here. Crypto, we haven't talked about Bitcoin yet. The Bitcoin ETFs, you all know this, one of the most successful launches of any product ever in history. Nearly $100 billion is now sitting in Bitcoin, and just plain spot Bitcoin ETFs, and more in futures and options. I guess what's next? We have Solana futures trading now. There you go. Okay, we got futures going. Sufficient size markets here. That's sort of a buzzword, folks. For their spot Solana's coming down the road. Any thoughts here?
Yeah, I mean, we'll see. Certainly the regulatory environment's much more favorable than it was just months ago, and you've seen issuers respond with just a raft of filings for everything from Solana to, I think the most recent one was for a Pudgy Penguins ETF. So I think issuers are trying to test, just exactly how far can we go to continue to expand access to these different underlying assets in a format that is just more convenient, more useful, more accessible to your average investor.
What I find, I've had issues with Bitcoin and a use case for Bitcoin for a while. I've been a big backer of blockchain in general, but one thing I've always supported is ETF wrapper is the safe wrapper to have. Just like I supported the gold ETF in 2004, people had gold coins, they lost them, they couldn't find them, now the gold's held in a vault, you pay a small fee, it's safe. It's the exact same idea for Bitcoin. Whether you think Bitcoin has a use case or not, doesn't matter. If you think it does, this is a safe wrapper to have for it, and it's been remarkably successful. Of course, you see when it's down 20%, you get pressure on potential outflows, but regardless, I guess the question is, can they replicate that with other? Is Bitcoin a unique use case in the crypto community, or can you do it with Ether or Solana or other forms of it? I don't know the answer, but
Bitcoin is very different from the rest of digital assets. I will say that it is really seen as this global monetary alternative, whereas Ethereum and a lot of other digital assets are more kind of a bet on the disruptive abilities of blockchain technology more broadly. What I would say is, I think there's been a lot of focus on innovation. I think there's just still a lot of focus on adoption of Bitcoin. We are still very much in the early innings of people thinking about, could Bitcoin be playing a role in my portfolio? Right now, you're mentioning, the success of IBIT and Bitcoin ETPs last year. Only about 20% of those assets that we've seen into IBIT have come from the advisor community. And I think as you see more millennials using advisors, as they build up their wealth, more Gen Z, more transition of wealth from the boomers to millennials, you're going to see more advisors thinking about how can I help my clients use Bitcoin in a responsible way in a broader portfolio.
Yeah, I mean, that's a good point. Only 20% institutional. I mean, that means it's mostly retail still going in there.
So it's about 50% retail, 20% advisors, and about 30% institutions is the breakdown today. And I think it's still very early innings for those latter two.
But it's also all about access. I mean, I think that's a theme that keeps coming up. And again, back to some of these other filings that we've seen, I think, again, it's a race to provide that access. Clearly, with the products that are in the market, there's been a proof of concept. I think another iteration that we're also going to see, and certainly in some of the filings, has been index-based products. Again, trying to target those advisors that really are not looking to allocate in between individual assets, but are looking for broad-based exposure, not just Bitcoin, but the wider
Travis,
market.
is the advisor community getting more comfortable with recommending Bitcoin? I mean, there are suitability issues here that haven't gone away. I said a few years ago, Bitcoin for grandma. That's a tough sell. What does it do for your portfolio? You have to say, well, it reduces volatility or it improves returns. You just say, oh, well, it's Bitcoin and it's a get-rich-quick story.
Look,
what does it do for your portfolio? How do you make that argument?
My sense is that a lot of advisors are still trying to figure out what they do with Bitcoin or crypto in general and where they put it in portfolios. Again, I think it's an access piece, and we've seen that for the industry. But the majority of flows and what we track and see, so that's one area that has seen some growth. You've also seen some of the leveraged and 2X type ETFs have some growth, but the bulk of the assets, and especially the bulk of the active ETF assets, are sitting in those traditional core sectors. And we see that as really the battleground for where the active ETF industry is going to be won or lost, Bob, over the next 5-10 years. So most of the development, most of the issuance that's been happening has been in those traditional core sectors, both equities and fixed income. So again, some of these other areas are interesting in terms of additional portfolio allocations, not something that we have been involved in on the crypto side, and we typically we're not quite sure where they fit in portfolios yet, but those traditional core sectors is where our focus is.
Ben Johnson, you have always been the voice of sobriety in the ETF business. You mentioned cushy penguins a minute ago. We were talking about this a little while ago, and I was asking, so tell me about all these new products coming out. You said new product development has officially jumped the shark. This is what Ben says. Remember, Ben's the philosopher here.
Channeling the Fonz.
And that there has been a proliferation of new products that cater to investors' worst instincts. So what's going on here?
Did I say that? I
did
did say that, Bob. And I think part of it is just part of the current zeitgeist, especially among young investors, that you're going to learn their lessons and going to take their lumps, no different than many of us in the past. Like, I used to think that I was going to be an exceptional stock picker, and that did not pan out for me. So, a lot of this product, a lot of the speculative product, leveraged single stock ETFs, now, product like battle shares that pits one stock versus another, long Tesla, short Ford, I think is designed to apply to some of our, or appeal to some of our worst instincts, to some gambling instincts. It's going to scratch an itch. Have at it if you do a good job of saying, I'm going to allocate 5% of my portfolio to just having fun buying lottery tickets. But I think, and I'm concerned about that vein of product development because it doesn't anchor in anything that long-term investment should be anchored in, which is growth, which is expansion,
Right.
which is investment, and benefiting in all of...
But you're not surprised that there's silly products that come out of at this point. I guess I have a broader philosophical question. Does the world really need 3 times inverse some stupidly high beta tech stock that's out there? Do we really need some of these products? And the problem I have with the industry is when I go to them, they say, hey, Bob, we're not telling people to buy this stuff. We're neutral on 0 data expiration options or a 3 times leverage inverse. We're not telling people to buy it. We're just saying, if you want to, here is our products. And so I guess it goes down to is there any responsibility at all to say, we don't need these products? And some people, places like Vanguard, said, we're not doing Bitcoin at all. So I know I'm throwing out an open-ended question here, but you get my point. He said it's sort of silly season and some of these that have happened.
I think you need an ethos to innovation in this industry. You know, the way that we look at it is, 1, is there an investment thesis to this exposure? 2, is there client demand? Do people want this? And 3, is it suitable in an ETF? And that has really guided the type of innovation that we've done at BlackRock, and I think that suited our clients very well. Even as innovation continues to proliferate, I think there's a lot of rationale for why a lot of products are coming, but you need to have an ethos for why you're bringing this to your clients.
Folks, this has gone unusually long, but you see why it's gone unusually long. You don't get a chance to have these kinds of all-stars, and those you don't know, we're in a gigantic convention hall at the Virgin Hotel in the middle of Las Vegas. So there are 2,000 people that are all milling around staring at us in the last 35 minutes or so. I know it's gone a little long, but I hope you'll indulge us, and I hope you got something out of it. I did. That does it for this week's ETF Edge from the Exchange ETF Conference in Las Vegas. My thanks to both Bens, 2 of them, and to Jay and Travis. We've asked Ben Johnson to stick around and provide us with some additional perspective on ETF trends for the ETF Edge podcast. That's coming up. And remember, you can see all of our shows on our website. We're in our 7th year for ETF Edge. That's etfedge.cnbc.com. Live from Las Vegas, folks. Thank you, and everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.